So we wanted to have a conversation. We've heard from a lot of different private equity firms, investment managers, private fund managers, and I wanted to have a conversation with a couple of premier private equity / venture firms about how they work with portfolio companies to accelerate growth. It's really a main focus of a lot of private equity firms, as you would imagine. When they step in and make an investment, how do they then help those companies go to another level? And as I said, I think we have two people here that are tremendous at doing that. I'll start with David Buckley, who's operating partner at General Atlantic. General Atlantic is a premier growth equity firm, and they have a division called Value Creation, and he heads up the growth acceleration aspect of that. So on all types of different aspects of working with a company, whether it's digital marketing or pricing initiatives, data science, all the different aspects of that, that's what David does. So David, thank you for joining us. And Patricia Kemp is a co-founder and managing partner of a firm called Oak HCFT. The HC is healthcare, the FT is fintech. You'll know Annie Lamont was here yesterday. She is one of the co-managing partners with Tricia, along with Andrew Adams. And they have created a premier venture capital and private equity firm focusing on those two really interesting industries. And Tricia works very closely with the companies that she invests in and oversees in helping to take them to the next level. So thank you for being here. So let's talk. Growth acceleration can mean all sorts of different things. Value creation can mean a lot of different things. Tricia, maybe let's start with you. What do you think of when you say value creation? What's that mean? If you're talking to a company and you're saying, we want to invest in you, and not only is we're going to give you capital, but we really think we can help supercharge your business in some way. What is that? What is value creation?
So first of all, good morning, everybody. So we deal largely with companies, I think, at a little bit earlier stage than David's companies. And many of them are just kind of going up the growth curve, 10, 20, 30, 40, 50 million in revenue, kind of growing at 40, 50, 60%. And what we talk a lot about is kind of what's needed for those next stages. And a lot of that is people. A lot of that is talent when you get to the first step. And many times some of these entrepreneurs are repeat entrepreneurs, but some of them are first-time entrepreneurs. They really don't know what they need in terms of a CMO or a CTO or a CFO and what that should look like and what the background should be. So I think the first thing we bring to bear is actually a kind of thought process on the people. And we do this actually even before we close the deal, Russell. A very extensive discussion about, okay, here's the roadmap of who's in each position. Are they a good fit? Do they need to be augmented? Does this need to change? How's this structure going to look in the long run? We have, and again, I think David will have this to a greater extent, but we have about 7 people on a talent team internally, on our payroll that kind of are tracking lots of different people in and around these spaces. So number 1 would be talent. Number 2 would be operations and scaling. Number 3 would be identifying customers. And again, we have operating partners with particular customer experience that could kind of, know banks or know payers or providers in the healthcare ecosystem that could kind of get right in there and help them with the pitch and help them introduce. But it's largely talent, customers, and then what I'll call generally perspective on ops and growth.
Makes sense. David, how do you guys look at it? Similar?
Yeah, very similar. I think the number one thing for us is human capital. It is talent, right? And so we have a dedicated team that does that globally. I think helping our entrepreneurs and our founders think through, what is the ideal board composition to help them and provide that sounding board and that guidance. What does that next level of management look like? So we have amazing management teams, but many times, in this growth path, that second or third level really hasn't been invested in or structured yet. And so we have a team that provides that thinking, collects data on this globally, and walks them through that process. We also have a team that focuses on capital markets, which might sound like a very vague term in this room, but our capital markets team also uses data to go out and help our portfolio companies think through the process that's required to prepare for exit. So IPO readiness and everything around that, many, many other things they do, and they manage our relationships more broadly with the financial services ecosystem. And then my team is in the middle. And so we're helping in growth acceleration, number one, identifying opportunities in due diligence, really throughout the whole process, throughout the whole investment life cycle, from sourcing all the way to diligence, and then partnering with select firms for value creation in the portfolio.
So you're coming in even as they're evaluating the investment and saying, hey, look, these are a couple areas we've identified where we can see immediate opportunities to help them.
Absolutely. I mean, I think one of the things we've learned is early involvement is key. So if you take something like one of the domains where we invest a lot of time is pricing optimization. If you come in year 3, year 4, year 5 of an investment, yeah, sure, maybe you can do some things, right? But if you already have exit on the horizon, you might not actually see the yield from those changes. And so if we're able to meet our portfolio, meet prospective companies very early on, we can quantify what the opportunity might look like. We have a chance to meet the founders, the entrepreneurs, kind of gauge what they're willing to do, let's say on the pricing front or digital marketing front. So we're a little bit unique in that our team, the way we've structured it is it's kind of like a mini McKinsey. I mean, we all create where we came from a little bit, I guess. And so, I have not only kind of these frontline people who came from, top tier consulting firms and can get things done, but I also have our research capability and our data science capability and kind of the infrastructure underneath so that we can bring data and bring these sources of insight to bear to help companies make marketing decisions, pricing decisions, and so on.
Interesting. Let's start with the talent conversation because I think it's really interesting. I don't know about you, but I think anyone who is dealing with a company these days is really in a little bit of a talent war, right? There's sort of talent is moving. I think probably more during post-COVID than even beforehand. For whatever reason, people are reevaluating their situations and moving from place to place. And I think the war for talent is real, and a lot of people are trying to figure out how to secure the best talent. I would think for both of you going into working with different companies and identifying talent, figuring out where to plug and play and who to put into different spots is very important. How over the years have you gotten better at that? What do you bring to the table? What's the approach that you and your team do when you look at a company and say, okay, these are the gaps we see and this is how we can fill them?
So first of all, you're correct that talent's getting harder and harder, and I don't know if David's seen the same thing, but engineers can basically name their price today, and it doesn't matter if you're Bay Area, New York, Lisbon, Ukraine, they can't find engineers, and so they're. And
you focus on fintech, so that matters.
Well, yeah, no,
right?
yes, it matters a lot, but
places.
engineers are kind of the hot commodity right now. So over the years, I mean, we were founded about 7 years ago, and so we've kind of grown with 4 funds, and now we have about 75 portfolio companies. We're a shorter tenure than GA. But what happens is you kind of build up a whole network and whole database, right, of people. And then we built up a whole talent team, and we're about 7 to 9 people now, and they know each management team, they know what spot we want to fill, they know we need a CMO, for asset management in Chicago. And they have kind of built a database that's kind of come up over the years of, superstars. And so and it is all of our jobs to nurture these superstars such that when we then have a role that they could be good at, right, and they might like, you're in a position. So you kind of have to track people, and you have to track people not only to be talent, but we track people to find investments, because what you find is good people go to a good opportunity. Right. So you completely track people, you completely nurture those relationships. You have lunches and dinners, and you involve them, and you maybe make them advisors to companies at times, and then you're in a position where there might be a great opportunity for them that they're interested. And I think David would probably say the same. I think part of our role is actually selling that person as well. So I think not only do we help the portfolio companies know, oh gee whiz, you need a higher level CFO and you need a new VP finance, and here are the search firms that are particularly good at that in your region for your slice. So we kind of maintain relationships with search firms. We've identified candidates and we introduce candidates in, and then we help sell, right? So it's a lot. I mean, talent's a lot. But what you're finding is the winner companies are growing at a faster rate. than the ones, I mean, this isn't kind of 10 to 20% growth anymore. This is kind of much higher growth rates.
Right.
And so what's happening with the higher growth rates, you have to augment management to a much greater extent.
Right. I do like that concept. It's almost like a general manager of a sports team that goes to a new team and starts bringing the talent that they knew from elsewhere. And I'm sure you have repeat customers
Yes,
that
we
you
do.
have
Yes, we
come
do.
with you on a variety of different portfolio companies. David, any sort of tricks or especially in this rough talent market that you guys have not to unveil any secrets, trade secrets, but how do you find, is much what Patricia talked about, or are there different other ways that you've had to innovate?
I think definitely a lot of parallels and similarities between our firms in that regard. Number one, I think we've attempted to become a lot more structured in the way we evaluate talent up front during the investment process and trying to learn from that. Where do we get things right? Where do we get things wrong? Sharing those frameworks and that sort of knowledge around how to evaluate talent in org with the broader investment base, because human capital is not a job just for one team or 3 people, right? It's a job for, I think, every lead investor or deal captain as they evaluate a new opportunity. But a couple of things in terms of placements. I think building a talent bank. We absolutely have seen a lot of impact from building this community of people that we can place in different roles who want to be part of the General Atlantic ecosystem that we've vetted and that we've met. And I think that helps us short circuit a lot of these sometimes very lengthy recruitment processes that we might go through with third parties. I think the other thing, though, that I would add here is, again, the importance of data. And I don't mean data in sort of, some large esoteric sense in terms of human capital, but I think bringing our portfolio company management teams like a real sense of the reality of comp at a granular level in certain environments. So I'm working with a company right now that, they're in Denver and they want to get a head of search engine marketing, right? And you're not getting someone with 15 years of experience in that domain who is top tier, for 70,000. I'm not saying that's what they're quoting, but
Right.
I think having the data to say, here are the last 15 times we've filled a similar role, in this geography. What does comp look like? What do people expect for career trajectory and comp trajectory? It really, really helps. And related to the data piece, I think, is being able to come in and move a little bit beyond the anecdote of, a best-in-class team has this sort of marketing organization or has, this second and third level within a sales team, but showing them, here are 10 companies in the JA portfolio and here's how they've cracked the code with talent. I think many times when you have these like high growth companies with superstar talent, right? The founder, he or she brings together amazing people around them, and you can have kind of that hero culture, that superstar culture of, we just get everything done. We're mega smart, and we've built this business from zero to something amazing. And I think counseling our management teams to realize that, now you need to step back a little bit, right? And you need people who wake up every day and think about nothing else except for search engine marketing or sales operations, right? And you need to elevate that talent and invest in that talent.
Can we talk a little bit about, you brought it up, and I think it's just interesting when you talk about a young founder, a hero culture around a founder. I think probably all of us saw the social network and how Facebook was formed, and that's probably gives us some familiarity with dealing with young founders or new founders and how they're building a company. What's the best way that you found to harness that energy and that talent of a management team or an individual, yet augment it with some of the structure and other folks around them that they need to go to the next level?
Yeah, absolutely. I mean, I think number one for me is the way our firm thinks about developing a best-in-class board, right? How do you bring in that external expertise that will be respected by a successful, ambitious founder? And by the way, many of our founders, they're not kids, right?
Right.
They are serial entrepreneurs, and they've had a few at bats.
So there's still time for all of us?
There's still time. Yeah, maybe one day.
Good to know.
So I think that's number one for me is equipping our founders with solid board expertise and that sort of sounding board. I think the second piece is trying to build a really productive relationship. Often it's our deal captain, right? It's the MD or it's the principals who are assigned to that deal, building that relationship. And then you get into the operating partner world. And of course, the operating partner world can mean many, many different things. Every firm has a slightly different model. We have some operating partners at GA. One of my colleagues led Microsoft in Europe and leads the top tech industry association in Germany and met with Angela Merkel every month, right? So I'm Kevin Bacon game. I'm 1 degree of separation from Angela Merkel, which I take pride in. But that's the sort of person who had great executive expertise, who had that gravitas in market and could be, could really be a mentor, right? Outside of the board meeting, outside of the boardroom, could be the mentor and the coach, and to say, hey, I've seen this before, and maybe it was big company, legacy corporate experience, take what you want from it, but here's how we thought about metrics and KPIs and governance and these things that you have to put in place to get beyond kind of a fly-by-night, make quick decisions sort of governance structure.
Interesting. Tricia, how do you look at it?
Again, very similar, but first of all, you need a superstar CEO to attract the next levels, right? So people will only come on board, what they think is a winning ship. And so you need the personality creating the culture and somebody that's going to attract, the next level down. Very similar. You surround them. Not only kind of as the whole deal team talking to them constantly, and many of these CEOs, vary in how much they want to hear from you. Some of them want to call you every day. Some of them call you every 2 weeks. Some of them, you're calling them every 2 weeks too, to be clear. But they vary in how much you're going to give them advice and how much they're open to that advice. But you then, again, you have surrounded them with a board. You usually surround them with an operating partner, and our operating partners, like David's, tend to be industry specific and have specific knowledge in, insurance, asset management, capital markets, payer providers on healthcare, can make the introductions, talks through pitches to certain potential clients and certain customers, talks about when they built their company. All of that, by the time you kind of have 4 or 5, I'm going to call them advisors loosely, in and around the CEO and team, it might take the 5th time for them to hear it, and then after the fact, when you kind of get a good CMO in there or something, they'll say, oh, Tricia, you were right? And, it might take them a long time to understand that you really kind of need to plan for success, but they eventually take it.
And if there's multiple firms, private equity firms involved with a company, I assume those teams of advisors will be a joint team of advisors coming in. Is everyone sort of, do the firms tend to agree on who should be put in place because it's almost like from a board level, or is other people? Is that usually done as a group as you decide how to approach it?
Well, a certain party usually takes the lead.
Yeah, typically. We will often divide and conquer in certain domains, right? We don't want to triple cover, double cover, marketing, for example, right? We'll say, hey, if you've got a great marketing team, a great marketing person, you take that, we'll take IT. Probably on the human capital side, the board side, you're kind of collaborating. You want everyone to buy into who we're bringing in or suggesting to the management team.
Great. So that's the talent sort of aspect of what you guys do. Let's talk a little bit about operations. When you go into a company, what are some of the areas that you tend to find is the quickest and easiest way to add value within an organization? Yeah. I don't know if you want to start.
So yeah, I can take that. Within our, within growth acceleration, one of these terms that can be very broad, it can be many, many different things. Like we've learned in about 40 plus years now, that there are a few areas where we can really, number one, create value, but really enable it as a partner, right? Enable it as kind of an outsider. 2 of these are on the marketing front, specifically on the digital marketing front, and on pricing. And I think the reason those things work is, pricing, for example, it's data driven, right? It's very difficult for me to have multiple hour-long conversations on pricing and keep them at a very high level. Oh, here are some benchmarks and here's how to think about it. Eventually, these entrepreneurs and these founders say, okay, but we need to figure out what their optimal price point is. We need to figure out what our packaging should look like. We need data. Can you help us? And so the way we tend to engage there on something like pricing is to really structure it almost like a consulting engagement. I think many of us who come from consulting backgrounds, there's good and bad in that experience. We've tried to take the good from it, and I think the good from a lot of that consulting work is, how do you rigorously scope out the problem that you're going after? Pricing in itself can be very broad. It can mean discounting. It can mean price point setting. It can mean packaging in a SaaS business, right? And so we will rigorously scope out what are we attacking and what are the sources of insight we can bring to bear to kind of solve that problem. And then my team will roll up our sleeves. We'll do perhaps a 6-week or an 8-week or more sprint and deliver a recommendation that's informed by data. So I think that helps cut through sometimes kind of the pushback you might get from a portfolio company that says, okay, you sent an operating partner who maybe is a little bit too high level or their experience isn't relevant for me. We're saying, let's co-develop this. Let's look at market data, whether it's your transactional data or whether it's data we, in effect, create through market research or through other approaches. And I think that has a lot of value and helps us be successful on it. And of course, pricing, right, just to beat the drum on that a little bit, hugely powerful lever, right? If you think of sort of the last, I don't know, 40 years of business, and you think of, at least in the early 80s, right, this kind of rise of like Six Sigma and Lean and all these really interesting things that were more like cost focused. And pricing takes us in this different direction of saying, especially for our high growth companies that are delivering a ton of value, okay, you're delivering a lot of value in the marketplace. Perhaps as a founder or as an executive team, you set your pricing model, but maybe you did it 5 years ago, right? There have been other things going on in your business to grow, and you really haven't focused on, do I tweak something that already appears to be working? And so we can be a little bit of that jet fuel to say, let's step back. Something is working in the marketplace. Let's stick a thermometer in the water a little bit and try to understand your customer's willingness to pay, your customer's perception of the value you deliver, how they want to buy, how they want to see the offer portrayed. So some really, really interesting stuff.
Any industries in particular that you're thinking of when you're thinking about that pricing?
It's all over. I think one of the great things about our experience at GA, because we're global and because we invest across multiple sectors, I mean, we've worked on really successful pricing projects all the way from the Starbucks franchises that one of our companies in Indonesia runs. And so we've thought about, it's not just the price of the latte, but it's how, what is the total bill? What is the impact on the buyer?
Is it less expensive over there?
It's a little bit less expensive,
Okay.
yeah. But you think about sort of menu optimization, there's a whole set of, really neat quantitative and behavioral things there. On the flip side, I mean, we spend a lot of our time in the US and in Israel and elsewhere with SaaS businesses, software as a service, right? And that kind of pricing is often less around, can I raise price by 2% or something like that? Tends to be much more around, okay, how do I maximize customer acquisition? I want an easy on-ramp where they can select the right package or something. And then how do I monetize my users over time? And so the pricing there becomes much more, understanding really the utility value of every piece of the product and of the offering. And it's some pretty cool stuff. You're dealing much more with like, should I bundle or not? Or if I develop a new modular feature, do I incorporate that in the existing packaging or should it be an add-on? Some really neat strategic questions that we get under.
Interesting. Tricia, take us into your world, healthcare and fintech, and what are some of the operational issues that are?
Well, just to add to what David said, a lot of what he's saying about kind of the strategy on bundling, and again, we deal with I think earlier stage companies in general, is related to the product. I mean, a lot of that's related to, okay, how are we positioning the product here? How are we positioning the product there? And we can kind of help think through, because we've seen it across, now 75 plus companies of, okay, here's how you can make the sales to banks, and here's, how you make it to payment processors, and here's what the positioning should be here. And you can change the pricing relative to the product, features and positioning. And, as David kind of said, ARR and getting the highest ARR. I mean, what you're paying, part of attention you're paying to is, okay, how are they going to get the highest multiple coming out the back end, right? And so what you want to do is you want to change, to the extent possible, the business model, right? For high recurring revenue, high margin business, service revenue, if there's any, is basically just cash to spend in R&D. So a lot of what you're also trying to do in and around, pricing and product positioning is what's this going to look like at the other end. I would add to pricing, and David does it to a much greater extent than we do, sales, the sales funnel, the sales function, right? So again, earlier stage companies, they don't know what it's supposed to look like, right? They don't know, okay, here's what our pipeline coverage is supposed to be, here's what our conversion rate should be, here's what it should be in this vertical versus that vertical, here's what level sales rep I might need or sales executive I might need for that, here's how I manage either regionally or I have it centralized. And again, you bring to bear kind of classic structures from other companies that venture partners or operating partners can bring in. So the sales funnel and managing sales, and again, that's high leverage, obviously in the revenue. That is a lot of interest. And then I would say in general ops, and this is a little bit related to talent, we kind of have a stable of interim CFOs, interim general counsels, folks that can kind of come in, interim COOs that can kind of come in and help solve this whole IFRS 15 thing, a year and a half ago, right, internationally, and whatever issue it might be from either an accounting or a legal perspective, a regulatory perspective. I mean, many of our companies in fintech and healthcare have lots of, regulatory umbrella around it all. So we have a stable of folks, either that, are on our payroll that can come in as an interim CFO, or the preferred vendors in and around this. And that just kind of makes sure the train keeps going down the track while you're moving these levers in pricing, product, and sales.
Can you give us a sense of when you talk about sales,
Yeah.
and you're talking about companies in your purview,
Yeah.
what does that look like? Can you a general sense of the types of companies and what the sales and how you've been able to at least help them think about the process and get a better understanding around it?
Well, sure. So an example would be a company we spent a lot of time with, is a company called Feedzai, payment fraud space, and out of Lisbon. Entrepreneur. We invested a few million in revenue, and now it's north of 100 million recurring. And it was kind of haphazard, right? They'd kind of show up at conferences and they'd make a sale, and they had no structure to it whatsoever. So it's literally kind of creating the database of the pipeline, and here's how long tier 1 banks might take. They take 9 months. Tier 2, tier 3 take 6 months. Here's the level of person you need selling to them. Here's who they need to be calling on. Here's what the here's what the end result should be a certain period out, and if that hasn't happened, that's when you need to sort of then be changing out the sales executives. Here, we sponsor them at all the large conferences and the booths, and then we'll have dinners so they can meet customers. So we'll add sort of the whole customer introduction element to it. But a sales pitch and a sales funnel, right, by vertical is very specific, right? And the level of person you need to be calling on a certain type of individual at the other end. And so that's where you can kind of bring in the knowledge of, okay, not only this is who you call at Bank of America, but you need this level of person calling them, and this is what the pitch needs to be.
It's got to be incredibly gratifying in terms of being able to move the needle, right?
Yeah.
And the actual business impact you're making, because nowhere is the bottom line more clear than the bottom line,
Yeah.
I would assume.
Yes.
Yeah. Let's talk a little bit about, and I don't know, David, if this is more in your area than Trisha's, but you talked about capital markets, sort of having them think about potential exits, and maybe it's just earlier stage, I don't know, but how much of this is also just preparing these companies for the next step in their growth process, whether it's with you or another source of capital?
Yeah, absolutely. I mean, we have a dedicated capital markets team, as I mentioned. I think so much of their work is around counseling our executive teams, our CFOs, around what it takes to get to an IPO. There certainly is a human capital dimension here. I think one of the things we think about all the time is we're evaluating new prospects, and as we envision that journey, as we envision kind of what the eventual exit would look like, is do you have the right people on the bus, right? And sort of the classic thing, the CFO who got you from QuickBooks to X million in ARR, is that the same CFO who's now going to get you, all the way to become a public company, right? And so there's a big human capital piece there around thinking through, do we have the right CFO? Do we have the supporting cast, around them to get ready for it? And there's kind of a change management piece, right? And being proactive and thinking out, a year and ideally much longer around what does it take, the disciplines we need, the data we need, the pitch we need, the relationships we need to be prepared for an exit. So we are long-term investors, and so we have a pretty, I think, robust and strong horizon with a lot of our partners. That's, I think, one of the key reasons that a lot of companies want our capital, right? We're not in a rush to exit, but that said, it's kind of never too early to start thinking about what that would be and getting the team in place.
How do you look at it, Tricia?
Well, I mean, the only thing I would add is, obviously there's relationships with bankers and their relationships with, industry participants. If I was answering this question 5 years ago, 85% of exits in, healthcare, IT, and fintech were just strategics, right? And now, of course, they've kind of become hot areas, and so there are many more, but going public and going through SPACs, et cetera. So we maintained lots of relationships with potential strategic buyers, and they had bought a number of our companies. So in that instance, right, we were in a position of being able to make those introductions. Now it's just generally you're kind of everything that David just said, if it's going to be a larger company that's going to go public or other. I think one element you could add to that, that many companies now take into account is, the company has to be ready, the company has to be performing, but in addition, there's kind of PR around it all. And many of our companies were now helping 18 months in advance. You need the articles to start showing up. You need this kind of positioning to start showing up. We need to have introduced you to these 3 or 4 people. You start a whole process of figuring out, okay, here could be this, if it's a strategic buyer, here could be the 5 strategic buyers, and you make sure you've introduced them. You make sure that they're, to the extent you can, there are articles talking about the company, that it's well positioned, that Gartner is putting them in the upper right quadrant and everything related to that, again, so that you have a good exit at the end.
Let me know if you need any good introductions to PR firms.
Yes, thank you, I know.
I want to open it up for questions. I have a few more of my own, but I didn't know if anyone has any questions. Slido looks like there aren't any questions here, but feel free to raise your hand at any point. I'll call on you. And did someone? Oh, sorry, right here.
I'd like you to address the private equity business from the following perspective. I know you guys get probably paid on a 2 and 20 basis. What I'd like to know is what percentage of your business, what percentage of the rate of return on your business is affected by your operating function? 2, what is your inventory turnover rate? Inventory turnover rate is defined here. I would define it as the number of businesses you invest in, how quickly you get the returns. So inventory turnover in a typical company would be important. In your case, you're rolling over those companies over how many years? So address the operating business of your business, the private equity business, and how it functions in those regards. So for instance, if let's say you want to get a 25% return on your money, and a certain percentage of that return is eaten up by your operating costs to operate the business. So you might get down to a 20% return for your investors. Does the LP fund the entire business, for instance? Or are we talking about revenue coming in from the investments that you have that you may charge a fee to offset some of the costs to run your business? So that's what I'm trying to address. Can you broaden that conversation in that respect?
I think we're both on the operating side, and I'm sorry to deflect a little bit, but I'm not on our capital partnering team, so I don't have all the facts at my fingertips. I mean, I will say qualitatively, I think the work we do on the value creation side is significant to our returns. It's also significant, I think, in attracting opportunities, right? I think as you both alluded to initially, I think a lot of the companies that want to be in the orbit of GA, they don't simply want, capital and a nice board member, right? They're looking for some expertise. And so in many ways, sort of unquantifiable in the sense of, we are winning deals because the partnership is more broad than just the capital, right? The partnership is being brought into an ecosystem, having access to our relationships, having access to our talent to help push some of these initiatives forward. I'm sorry that's not answering you, quantitatively on that dimension. In terms of how we think about exit, that sort of inventory turnover question, right? I mean, look, we do have a strike zone of could be 4 or 5 years, right? And that's when we're delivering capital back to our LPs. And so I think for us that strikes a nice balance of, for our entrepreneurs, that's a little bit of patient capital, right? Where we don't have sort of the stopwatch going the moment we walk in the door and say, aha, we're now investors, right? There's time to develop a plan together, right? There's time to help the business grow. For our LPs though, right, it's also not waiting forever, right? This isn't, we're not dealing with 15-year funds, and so it's definitely something that is top of mind for us. So sorry, I'm not giving you the factoids you want, but.
Okay. And just to add to what David said is, I mean, the reason firms are doing this is because it's creating value, right? And so, you could sit there and say, well, would they have figured it out themselves? And is it really helping or is it not? It's a little nebulous in the sense of we win deals because of it, and it's a very competitive world out there. And in addition, we're working with the companies. Now, would they have gotten there themselves? Would they have found a better, CFO or whatever it might be? I mean, you could have a long debate about that, but the pace of growth is greater than it was 10 years ago. And so our helping them create that value is, it's needed. So I think it's a very necessary step. LPs look at net IRRs. And so again, I'm not going to go into specific numbers, but they're deciding to invest with whichever firm because they are looking at net IRRs. And similar, to David, we on average are 4 to 5 years, but we have investments we're in 10 years. And again, LPs kind of decide, that they are betting on getting that return. Was past performance equal to future performance or not? But that's usually the decision, and that's usually the stat they're looking at: return on money and annual net IRR.
Yeah, I would add one other thing. I mean, I think, we're now moving towards like Gen 2, I would call it, of kind of the private equity operations capability, right? And sort of Gen 1 was very typically you have some sort of resources group or operations group. It's, seasoned former executives, right? Maybe they have kind of a board role, a counseling role, et cetera. And I think certainly in that world, for many firms, quantifying the impact of your value creation efforts maybe wasn't robustly attacked, or it was a little bit difficult to do. And certainly there's some domains like, hiring the right CFO. How do I put a dollar value on that? I know it's intuitively the right thing to do, but how do I quantify it? In our world, as we look at things like growth acceleration, as we look at pricing, I have a model for every deal and every portfolio company interaction that I work on, or my team works on in tandem with the investment team. And we plot out, we enter, if I make a recommendation to Duolingo or Quizlet, two of our consumer apps companies, if I make a recommendation on how to change your pricing or packaging, I see absolutely how that flows through the model in terms of influence revenue from the GA side, how it influences the value we deliver back to our LPs, the value that it creates for the company, right, for our partners. So I do think in this kind of like Gen 2 world, we collectively, like in this industry and on the operating side, where possible, need to be much more upfront and much more rigorous around, is this meaningful? There will be a bucket of things that are always going to be a little bit ambiguous. Sales, for example, like I love sales work. I've done a ton of Salesforce effectiveness work, and I have found Salesforce effectiveness many times is either a human capital issue, get the right sales lead, and it sort of flows from there, or it's a major change management issue, in which case someone like myself can be drawn into a 12-month debate with a sales team on what their compensation structure should look like, right? It's just, you're iterating over and over, and then you're done with it, and you've set this new sales comp structure, and you're like, oh goodness, how do I model this? How do I prove? I know it's better, I know it's more logical, I know it's more aligned with how I want them to sell or drive renewals or whatever, but I can't prove it. But on the pricing side, where we tend to major, right, I can absolutely model out what the value is that's delivered back to the LPs. I think they're hungry for that, right? And it also justifies our resources, it justifies how we engage. Same thing on digital marketing, right? If we can go in on the digital marketing side, we can prove that we've helped influence in partnership with our portfolio company teams, how conversion evolves. It's meaningful. So I think it's really helpful to start to focus on some areas that are very, very quantitative and move beyond a little bit of that ambiguity around, oh, we're helpful, right? I mean, no, let's be helpful with a focus on ROI, because ultimately we have to be responsive to our LPs. And our LPs are not envisioning a world in which we build out, a full McKinsey at a firm like ours, right? Very targeted and very focused.
So I'm usually the guy that cuts off the time, but since I'm that guy, we can go a little bit longer. Let's just take one more quick question, and then we'll wrap it up from there.
What happens when your interests are not aligned with the founder's interests?
Yes. Well, isn't that like I'm going to sound like a Star Trek dork, and I'm not, but isn't that like the no-wins and the Kobayashi Marus? I don't know. Why do I know that? I shouldn't say that publicly. Yeah, the no-win situation there. Well, ideally, you never enter the no-win situation, right? I mean, you are building relationship with the entrepreneur, the founder, the management team prior to the investment. We try to be very, very upfront and align on what it is we want to do together. I mean, you should not go into a deal obviously having a completely different vision for how the exit might evolve, right? And we're investing globally with companies that have very different senses of how they want to take things in the coming years. So ideally, aligning on key decisions like exit, aligning on even like a value creation plan, right? I mean, I think one of our key learnings is for our portfolio companies, they already have so many things going on as high growth firms. You can't come in, or it's less advisable to come in with the 49 things that we'd like to do, right? But what are the 3 or 4 or 5 kind of major streams of effort? And can we align on those before we sign, right? I think that's key. And then the final piece, look, I think it's our deal captains, it's our board representation, building that relationship, and continuously trying to align. I'm trying to think of major off track sort of situations where we don't align. I mean, look, I think
We'll save those for the next panel.
Save those for the next panel. Yeah, difficult conversations.
Anything?
Well, I'd
you wanna
say,
add?
and again, it's earlier stage companies, and the deal team is talking to the CEO constantly before and after. The biggest issue tends to be on exit, right? Is it time to exit? And should we exit? Should we not exit? And of course, if the CEO thinks it's time to exit because he sees something happening in the industry or in his marketplace, then you should exit, right? But and it's also in and around acquisitions. I mean, we haven't talked about it, but I'm sure both firms are very helpful in identifying possible acquisitions. But again, they lose focus. Is it too much to bite off? Is it going to be a positive outcome? Those sort of strategic decisions are where you end up having, some difference of opinions. But you invest in these companies, you're basically hopping in bed with them, right? And you're hopping in bed with these teams. And so there's a relationship there, and you're constantly talking about these things.
Thanks for the questions. Thank you both, David, Tricia. David Buckley, General Atlantic, Tricia Kemp, Oak HCFT. Great conversation. Really appreciate it.
Thank you.